All right, everybody, let's review the market, and we'll start off with nat gas. Nat gas had a good trade today, all right, but it was a little tricky. Why? Because of the shakeout. It's a minor shakeout. Anyway, nat gas went down to a level, and then I saw this big green bar over here. So I knew it was going to react. What I didn't anticipate was a climactic bar here. It did occur, and after that you had this heavy buying activity. So this automatically tells me the trend has changed. All right, so no longer downtrend, we're in an uptrend, and the quality of the buying is pretty obvious. When you have green bar, green bar, green bar, green bar, one little red bar or gray bar, and green bar, green bar, green bar, green bar, green bar, green bar. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of 11 bars were green. 10 out of 11 bars. So that there's no way this is not buying activity. You know, you have that many green bars in a row off of a level. It's typically a trend change. So it hit the climax. This was all at a level. And this volume is 2 times average down volume right here, bigger than last 9 bars. 2 times average means 200%. So it had no follow through, and instead went the other way, which is one of the things you want to look for. Is when the market has high volume break in one direction, and then goes in another direction. So it has this crack below this low. You expect it to go lower, but instead it goes the other way with a lot of strength. This is a climactic action right here. The bar is climactic because it has 2 times average down volume, 2 times, meaning double, and it goes all the way up here, meaning it goes the other way. Green, 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 green. The same thing applies in the other way around, where you have a red bar on top of a trend, and it has not a red bar, but you understand that when it has a buying climax, right, and then it had all red bars going down, it's usually a change in trend. Anyway, so after this, it was just a matter of getting in. Initially I thought it was going to be right here. It went here, tagged, reversed, and I thought it was going to go, but instead they did a minor shakeout across this low. So across this low, another climactic bar right here. So that is your spring. That's your classical spring. All right. So where you have stopping action and then ending action. This qualifies as your ending action. And initially you think that, okay, since it did that, that's it, game over. We're going to continue down. But as I've explained right here, when you have heavy volume going in one direction in one bar, and then you have a strong buying wave in the other direction, is a trend change. So that's what happened here. When 1, 2, 3, 4, about 4 green bars went the other way on a good amount of volume right here. This volume, there's a lot of volume. So this is when the market was ready to go. Here, it was very strong, but they did a shakeout, and that's fine. Sometimes that's what happens. A shakeout occurred, and then went up. Just keep on going. See, keep on going. All right, so that was the trade in nat gas. So this one, even if you get stopped out, let's say, it goes up, pulls back, you get in on this test, and then it goes up, you go to break even, shakes you out, or stops you out here. Once you see it rally again, it's back in business. Right? The key is do not get in here, because since it took out the low, it can possibly continue to go down. Meaning it could be a turn failure, it could be a change of behavior failure, and continue going down. Meaning they could have sold the automatic rally, or this, whatever you want to call it, sign of strength, once it takes out this low, that means it's possibly going to go back down. The only time you consider re-entry is if it has another rally like this one, and it did right here. Now it's back in play. All right? It is an error to get in right here after the stop run. And let's say there's a stop run and then it's a green bar and you just buy it over here, right? Because you got stopped out here, got in over here, cross this high, break, pull back, entry, get stopped out, and then re-enter on the green bar. That's a mistake. It has to reprove itself. I mean, the whole thing has to occur again once it takes out the low. Why? Because if it takes out this climax low, the chances of it going down increases. All right, it increases. You don't want to get stopped twice, so it has to reprove itself, and then you can re-enter. All right, that's how you do it. All right, and on the ES, I think the NQ is more clearer about where it was. Yeah, I mean, I think a lot of people got faked out today. Why? Because it gave them a selling, strong selling wave. So, what do you think is going to happen after a strong selling wave? It rallied down, pulled back, not weak, but relatively weak, right, compared to the down wave, and makes a lower low. So the idea is that it comes back here, take the short, and it goes back down. But instead it went the other way. And this is because if you don't know the high time frame trend, you're done. All right? The reason why, if you went short because of this and got stopped out and went the other way, is because you don't know the higher time frame trend. The higher time frame trend turned on Friday to bullish. You could tell by the close of the NQ on Friday towards the end of the day when it rallied up. So it seems like all they did was just bring this low, buy it up right here, and go up. Same with NQs. These are very strong sound waves, but they gave the wrong perception to everybody and induced them to get in. So this move shakes out all these lows and then goes the other way. But this is interesting. This is interesting right here because climactic action. I might take a look at it right there. This is interesting. Look at this. I'll have to take a look later. Oh, this one set up also Euro, but the thing is, it didn't pull back in time. So I don't know what to do with this because I'm not going to wait all day for it. Right? So basically, price goes down to a level, right? It has to go down to a level, and then you know the sequence: climax, automatic rally, and all that crap, right? So this is it. I've codified it. There's your climax. Why is it a climax? Why is this the climax? This is 3.25 times average volume, triple the average volume, and the biggest volume in 19 bars. Again, 3.25 times average down volume, times average volume, and biggest volume in 19 bars. And what happens? Does it have follow through to the downside? Does it break down? No. It goes the other way with massive strength. Green, 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 green. One red, green, 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 green. It's like 20 bars here. And almost all except one is green. So this is your climaxing automatic rally. Alright, that sequence of climax, automatic rally, secondary test. Right, which is, this is how you do it. This is the climax, this is the demand. And now, the whole problem with this thing is that it just triggered all the buying without giving a pullback. So, you know, what are you going to do? All right. So this was the second turn that was clean that I saw, but it didn't pull back in time. It still hasn't pulled back, you know, to an acceptable low area of risk. So that happens all the time, you know. Out of all the turns, there's only a few, not a few, but you know, a percentage that will come and give you a pullback entry. And then out of that, there's a percentage that work and or don't work. Right? You just have to, what I'm showing you here is how to detect very likely the ones that work. Why? Climax, and then green, 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 green. So that's buying activity. Climax, instead of going down, it goes the other way with strength. All right, that's the reaction off of liquidity and all of that. All right. So next, this was also a good one, but there was, you know, again, they have to pull back. It didn't pull back. So the first thing we see, climactic action. See that? So I've experimented a lot where I know how to identify this stuff and where to look for it. All right. So that takes a lot of time to figure out, and there's a lot of nuances and whatever, but eventually you get it right. All right. So here, this is climactic. Why? Because this is the biggest volume in 24 bars. That's good enough. 24 bars. And it's significantly above average, meaning it's at least 1.5 times the average down volume. Does it have follow through to the downside? Not in this wave. There's some little waves after that, but this bar, or this behavior, is problematic for the bears, because it shows that instead of going down immediately, it pops up immediately. So someone is stopping that. They're stopping it. Yes, it doesn't necessarily have to have buying activity right afterwards. It can happen, you know, a couple of waves later, but it's close to the end of the markdown. All right, entering accumulation. Right here means that you're entering accumulation. All right, and then it has to prove itself with the sign of strength, and that's it. But you see, the majority of the bars are green. The problem is it didn't pull back, so no cigar. But it'll just happen tomorrow, you know. So that's what happens. You have to be careful, because if you see a climax and it's at a level, then you have to look for a strong reversal. Like here, reversal. Otherwise, the climax would just be hitting, you know, large limit orders and look like a climax, but you need to see it. Otherwise, it's just hitting large limit orders. All right. Nat gas we already went over. That was the trade. Gold. I don't know what was here. Something here. You see this pattern emerge. You see that? Now I didn't catch this, but if I was looking at it, I would ask myself, why is it that this bar has the biggest volume in 100 bars? Why is it that this bar has the biggest volume in 100 bars, and instead of going down, because it's a down bar, instead of it having fall through to the downside, it goes the other way and rallies? Isn't that a good question to ask? Why is it that you have a break, you have a bar, a down bar, with the biggest volume in 100 bars, and it has no follow through to the downside with all that perceived selling pressure? It has no follow through to the downside, and instead it goes the other way, rallies on the biggest volume in biggest green up volume in 20 ways. Isn't that a question to ask? That's because this is the climax, this is the automatic rally, that's why. And then it goes up. Climax, change of behavior, or automatic rally, or sign of strength, whatever you want to call it. I just call it demand. Why? They hit it, reacted, and look what happened. Similar here, these moves, but again, I prefer to look for them at key levels, because you know you can have a lot of volume just because it's hitting a large order, so that there's no point. You need to see it at levels. All right, next is there's nothing here. Well, there is something here. Here, you had 45. That's the biggest volume in 45, with the 45 bars with 3.2 times average average volume. Does it continue lower? No. It rallies. So there, this means that this is your climax. It's your automatic rally, and we're in an uptrend. But again, the problem is a lot of times this thing doesn't pull back. So you want to see that strength and then a pullback. And right here, I can't really detect the strength of this buying right here. This I can detect. This I can't. Go to the next market. Same thing. First, you need it to go one way. That's the highest bar, biggest in 84 bars. Biggest volume in 84 bars. And instead, it closes down and continues to go down. So it's game over for that particular market. All right, so what did we cover today? We covered how markets typically turn. You have the climax, and then you have that automatic rally, and then you have that secondary test. Right? This is the pattern that is taught to you in a lot of the online literature. But there's a way to do this, right? You can't just look at it in hindsight and mark it up. Excuse me. There's a way to do this. All right. So climax, automatic rally plus secondary test, and automatic rally is also your change of behavior. It's also called the Koch, change of character. It's also called sign of strength, whatever you want to call it. But this does set up the trend reversal. This does set up the trend reversal, no question. I just showed you multiple examples, and these are all from today. Nothing cherry picked. It's all from today. Right? So this stuff was there. This was around then. It's around now. But to be able to go from reading a manual to or something online to actual implementation is another story, right? So what you need to see, and by the way, this is why you must have bar volume. So there's a lot of emphasis on volume profile, and I get it. There's a lot of emphasis on volume profile, but you're going to miss the climax if you use volume profile. That's why you need bar volume. You need bar volume in order. You can use volume profile, which is very helpful, but you need bar volume for climactic action, which identifies the end of a trend, or very, very close to the end of a trend, meaning it occurs and now just wait for it. All right, end of a trend. So this is extremely important information. It can only be interpreted from bar volume. It cannot be interpreted from volume profile. So that's why you need bar volume. And you can use volume profile as well for trade location, identification of value, value shifts, whether value is going up or down and stuff like that. And other stuff, but bar volume, the main piece, intraday, even Wyckoff style traders will only focus on wave volume, and if you only focus on wave volume, like Weiss wave, it's good because you can see the strength of the demand and the strength of the supply, but it is a mistake to leave out bar volume. Bar volume is critical for the identification of stopping action. Like I showed you in this video, that's why you need bar volume, and it works even intraday. It actually works. What happens is it spikes, and you have that outlier volume, and instead of continuing in the same direction, you get a reversal in the other direction, which helps you confirm that there's a change of character, and then you see this climax automatic rally test sequence occur. So you need bar volume. You can, without bar volume, it's very iffy that there's a change of character, because the bar volume, it's almost like it serves as a support, that heavy volume there, because if there's a lot of volume there and price goes back and touches it, whoever's on the other side is going to want to cover, and it serves as almost like a support. Anyway, that's all I got. Thank you. Have a good day. Bye.